Chapter 16, Part 3, Allowance for Deferred Tax Asset and Loss Carryback, although we can't do that anymore, we're going to go over it, and carry forward. Now, because of conservatism in reporting, the rule for deferred tax assets is, if a portion or all of a deferred tax asset is more likely than not to be realized, which is more than 50%, you must set up an offsetting account to the deferred tax asset. And this would be true of a company, usually when you start having losses, especially if it's not right at the beginning of when the company starts. Chances of you recovering for that is not good. So we set up a account called Valuation Allowance Deferred Tax Asset, and it's a contra account. So let's take a look at an example. My corporation had a deferred tax asset of $20 million at the end of 2020. At the end of 2021, the deferred asset was $10 million. The company had taxable income of $100 million with a tax rate of 25%. So I would suggest T accounts. It really helps you visualize what's going on and make sure you get your debits and credits right. And please pay attention to your journal entries when you're doing the T accounts. If you credit something, then you have to credit it on the T account. I see that a lot. All right, so there's our deferred tax asset, and it has $20 million in it, and we credit it with $10 million when we did our year-end taxes. So now we have a balance of 10. And the journal entry at year-end to record our tax liability and expense would have been income tax expense, deferred tax asset, income taxes payable. So that would be our journal entry. So that was credited to the account there. Now, what happens if we're assumed that at year-end only 50% of the balance in the deferred tax asset account is going to be realized, and we don't have a current balance in the allowance account? Well, we'd go 50% times 10 million gives us $5 million, has to be written down. So we would go valuation allowance, deferred tax asset, and income tax expense we'd add $5 million to it. Now, it is believed that this valuation account allows companies to manipulate earnings because the process of determining this particular allowance is subjective, but hey, that's true of all estimates that we use in accounting. Now, what if we already had a balance of $6 million? So let's look at our T accounts. This is what transpired. We have $10 million there, and now we're saying it should be, the valuation account should be based on, so there would have been our entry for when we originally did our journal for our income tax expense and income tax payable. Now, we've got to adjust our valuation account. Now, here's the thing. We know it has to be $5 million. We already have $6 million, so we have to adjust it by $1 million. So we're going to go valuation allowance, deferred tax asset, and then we would reduce our income tax expense by $1,000. Now we're going to go over net operating losses. Now, net operating losses occur when the taxable expenses exceed taxable income. The federal government allows the loss of 1 year to be loss carryback. Carry the loss back for 2 years against any previous taxable earnings to the earliest year first. So that would mean in 2020, you'd have to go back to 2019 first, based on that year's tax rate. And then you set up a tax receivable. Now, unfortunately, under the new tax law of 2018, the loss carryback provision has been eliminated, and the loss carryback forward is limited to 80% per year indefinitely. So we can go forward, but it's only 80%. Loss carryback. It used to be you could only go forward 20 years. And a lot of times what would happen is people would see corporations with these huge deferred tax balances, and they would buy the companies even though they were losing money so that they could use it. But they've set up restrictions against that now. So let's take a look at an example. Now, Spam Inc. reported a net operating loss of $200 million in 2021 for both financial reporting purposes and tax purposes. Assume the carryback provision is used for this business. And I guess they did allow the carryback for some businesses. The current tax rate is 25%. So what that would mean is we would have to first go back to 2020 and then go to 2019. We can only go back 2 years. So here's what we would do. We would determine the amount that will be a receivable. So it would be 2021 loss of $200,000, and we take our 2019 profit that we had times 25%, and that would tell, and we'd have our 2020 at 30%, and that would tell us that we are going to have a carry forward of 2250. We're going to have a receivable for 30, and now we can do our journal entry. So first we're going to do our receivable is 30, because that's the amount of taxes we paid in previous years, 2019 and 2020, and we now can get a refund from the government. We have a deferred tax asset, which is the balance that we would use as a carry forward of 90 million, and that's 22.5. And then we would book income tax expense of 52.5. A credit, it would reduce our income tax expense. So let's take a look at the income statement. So what we would do is we have loss from operations, income tax benefits, and now we would report a net loss after tax of $144,500. Now, what happens if in 2022 we had net income of $100,000 and the tax rate was 25%? So, deferred tax asset would be $90,000 times 25. Loss carry forward of $90,000, that was from our last slide from 2021. We'd have income taxes payable, which would be our $100,000 minus the 90 times 25%. Now remember, this is under the old tax law. And income tax expense would be $25,000, which is always a plug. Now, if we were to do this same thing, but let's do it under the new tax laws, because we can't do carrybacks and we can only defer 80% at a time. So here we go. Same example. So they don't qualify. Like I say, when they did away with the rule, they left some companies and gave them the benefit of this. So they can only do the carry forward. So for your journal entry for 2021, they would get to credit tax expense, and they would have to set up a deferred tax asset of $50,000 as a carry forward. Now, for 2022, here's how it has to work. You're going to take the 100,000 times 80% times 25%. You're going to take the 100,000 minus the 80 times 25% gives you 5, and that gives you your income tax expense. Because the rule is, see, you're adjusting for 80% of the previous years, the carry forward. Okay, so you can only get 80% of your income. That's how it works. So here's another thing to remember. Taxes payable is a liability, and tax refund receivable is an asset, and are always shown in the current section of the balance sheet. Deferred assets liabilities are always shown netted together as part of non-current on the balance sheet. It doesn't matter if they're current. You treat them as non-current because they don't want to affect that current ratio. And that concludes Chapter 16.